Good afternoon, everyone. Welcome to my channel. First, before we start, I would like to say like and subscribe to my channel. You're going to see a red button to the right and like it. And likes are free. Subscribe, and if you subscribe to my channel, we're going to talk about investing. This is a series that I'm doing. This series is how you can invest into your 30s to retire wealthy and rich, and it helps because uh, I'm in my 30s, and so it helps to understand where to start. My last video that I did was how to uh, invest in your 20s to be able to retire early, and it helps. So with this video, I'm going to go over how to organize your thoughts, how to sit down, where to start. Hopefully, in your 30s now, I know a lot of times individuals are in the process of figuring out if moving away from renting in an apartment to want to buy your first house. I know some individuals in their 30s, they're having children. If they have already haven't had children, they're getting married. They're consolidating assets, and this is right around the time where a lot of people are making more money and now trying to figure out, whew, I got over my 20s. I'm not broke anymore. I got more money, but I want to save a nest egg. How can I go about it and tackle this investing thing? Let me show you. Let me show you and instruct you on how to go about this. The first thing how you go about it is you look at your debts. For me, I have a video showing how to do a budget. You do a budget, you figure out how much money you spare money, net income that you have coming in into your household on a monthly basis, also on a bi-weekly basis to see how much money you can spare. Uh, I showed an example and I have another illustration that when you're in your 20s, you can all you have to do is invest roughly $200 to $210 per month. And because you're starting out so young, you don't have to invest so much. But as us being in our 30s, we don't have that luxury. So if you at this point have been investing into your 401k, great. You've been getting that match, great. Now it's time to increase uh, the urgency. It's time to figure out what type of either ETFs, index funds, or stocks. Stick with that strategy and ride out till it's time to retire. But at this age, it's time we got to figure out a game plan and operate on that game plan. So figure out your debts first. Your debts first. Any high yields, a high percentage, knock those out, and then now we can figure out how we want to invest our money. Again, right here in the article shows that participate in your company's 401k plan. And like my last company at Curec, they match up to 8% dollar for dollar. Whatever, if your company is giving out that free money where they say they'll match whatever, take that because that's free money. Also, around this age, individuals are opening up a Roth IRA. I'll go into more detail what a Roth IRA is in other videos, but basically, it's a vehicle where you put your money into, like a 401k, where you are putting your money into this vehicle. You put in stocks, ETFs, crypto, whatever into your Roth IRA, and you letting your money grow tax free because the money that you're making at your job is taxed by the government. And then so that money that we use from our wages, you can put it into the Roth IRA, and since it's already been taxed, you just let your money grow 5, 10, 15, 20 years, and you're going to amass a portfolio over $500,000, $600,000, $700,000, and if you really contributing enough money, you can get up to $1 million. So it helps. Also, another thing, you sit down with you and your partner, or if you're single, just yourself. Hopefully by now you figure out how to do a emergency fund. Start out with $1,000, and then once you work from there, build up to it. Add extra $100 into your emergency fund per month. Get that $1,000 up to 5,000. Get that 5,000 up to 10,000. It helps to have an emergency fund because for me, for example, I have a house and things break down where it may be a refrigerator, it may be plumbing, it may be you get into a car and you got a flat tire and you got nails in your tire and you need to get new tires, and new tires may be $400. It helps to dip into the emergency fund where you don't have to deal with dipping into in your finance or your day to day. And then most importantly, while we're here, is to invest into more stocks. Get risky, invest into more stocks. Yes, we're going to talk about invest more stocks. I'm going to go into details of ETFs for what you can invest into. We're going to at this age, if you haven't been investing, we're going to start investing. We're going to ramp it up with more risk. We're going to invest more, and then also we're going to diversify our holdings. You're going to look into S&P 500. You're going to look into Nasdaq. We're also going to incorporate real estate into our portfolio to balance out our portfolio for more income. If you have enough money to buy that house, to buy commercial property, then do it. If you don't have that money, then don't feel bad. Invest into REITs. I have a video about REITs and real estate investment trusts where you get real estate exposure, but you don't have the physical properties. If you look into one of my videos, it will go into more detail of what REITs are. And let's go into detail of what things you can do to invest in your 30s to propel for you to be well off when you retire and to be rich and wealthy. One is the ETF VU. It's the S&P 500. It's the top 500 companies in the United States. It costs $356.44 a share. This is my bread and butter to advise. When I advise individuals, like how do I get started? And like invest into the market. Into VU, it's the S&P 500. It holds Apple, Microsoft, Amazon, Google, Berkshire Hathaway, Tesla, United Health, and basically reason why people invest into ETFs because it's a basket of stocks. So the S&P 500, when you invest into VU, you are investing into 500 companies. So if one company goes down, you can rely on the other companies to figure out it's going to do well. And whenever the times of a market crash or a recession like this, where it's like extremely red days, it will really protect your investment from going down so much. It may go down, but it won't go down as much as a high risk of just a growth stock or just regular stocks. Because we know that stocks are risky. Crypto is extremely risky. So when you invest in just one singular stock, risky. But when you invest in ETFs, there are basket of stocks, and so it hedges against market downturn and etc. And so keep that in mind. VOO, VOO, it's the S&P 500, the top 500 companies, and the next ETF that people look into is VTI, Vanguard's Total Stock Market ETF, and this ETF costs $194.13. And the reason why a lot of people like this over VOO is because VTI is the whole entire stock market. So you can't go wrong with betting on America, with our whole economy. VTI is our whole economy. So when we do good, you make money. When we do bad, you lose money. But at the same time, you're betting on the American economy, and you can't go wrong. And what's inside of VOO is the same thing that's inside what's inside of VTI. This is also what's inside of VOO. So that's why usually individuals either pick either or. They either choose to invest into VTI or VOO to get market returns. And in VTI, it's Apple, Microsoft, Amazon, Apple, Tesla, United Healthcare. And then usually what a lot of people do outside of the market ETF is the people want growth. And also while you're in your 30s, if you've been investing and you started, great, continue. If you haven't started, then the best route to go to is a growth ETF. VUG is Vanguard's growth ETF, and what individuals tend to do is that they know that I'm not in my 20s no more. I'm now in my 30s. Now I need now I need more growth. Now I need more returns. And as with that, you utilize a growth ETF. And in this growth ETF, As it says in the name, it has nothing but growth companies. It has Apple, Microsoft, Amazon, Google, Tesla, Nvidia, Visa, Home Depot, and Mastercard. And this growth ETF, it costs $216 per share. And what people tend to do is that they'll buy a S&P 500 fund or VTI, the total market, and then they will buy a growth the growth ETF, and then just leave it as that. Another ETF, what a lot of people invest into is QQQ. QQQ follows the Nasdaq, and with the Nasdaq with that index, it has Microsoft, Apple, Amazon, Google, Nvidia, Tesla, Facebook, Pepsi, and Broadcom, and other different type of tech companies. QQQ costs $270.50, and typically what a lot of people do is that QQQ gives you a lot of more bang for your buck in terms of market returns. Like usually it's like double the S&P 500, but as you know, if it's double in terms of returns, it's extremely risky because it has tech companies on the good days, it's doing really great, but then on the bad days, you'll see that it will be sliding a lot. And if you look right now, I invest in QQQ. I'm down roughly like 25% because we're in a recession right now. But it's the best time to buy. So the best instruments to buy in your 30s, different type of ETFs is VU, VTI, VUG, and then QQQ. Now, if you want to try to catch up and get even more returns, the best way to do it is to go about it is to invest into individual stocks. When you invest into individual stocks, you're able to get more returns. But with more returns is more risk. You can buy Apple at $130 a share. Over a 5-year annualized basis, it has produced a returns of over 198%. A person can invest into Tesla over the last 5 years. If you used to invest 5 years ago and you put your money in Tesla, your money would have produced 421%, which means that if you do 420 divided by 72, that is what you would have gotten in terms of how much your money would have doubled. Other stocks that people buy in terms of these are all growth stocks. Amazon, which is at $89.74 right now. So if you have about $100, you can spend $100 and buy a share of Amazon and then let it grow. Another stock which is pretty popular since we are on YouTube is Google, and Google right now is also under $100. So typically, what people tend to do is that they will buy a market ETF like VU, VTI, VUG, and then if they want even more exposure, they will add like Apple or Tesla to their fund, and then they would just invest in that per month and then watch to see their money grow drastically. And then also in your 30s, since you want to consider growing your money fast, a lot of times individuals also invest into some dividend stocks to be able to help out with the bills. And so I would say that since you are in your 30s and we are in our 30s, you still want something between 2 and 5%, but also just growing the dividend also a lot quickly. So I would say like Comcast, American Tower, FedEx, Medtronic, what else? Lowe's, Centos, and these stocks right here, it helps with basically a portfolio where you're able to invest into these different stocks. It gives you income, it's going to grow, and you don't have to worry about the stress of bills, but also your portfolio is also growing. Let me give you a couple examples of other stocks that will help out growing your portfolio while in your 30s. Another stock that will help out is Ultra Group, Johnson & Johnson, Verizon. We all know Verizon, right? Ring, ring, right? And then also Pepsi. Also went through an example with you guys on how to start out with a portfolio if you haven't been investing and you're starting out from zero. If you're just starting out from $0 or just $1, and you contributing $500 per month on a monthly basis for 20 years, because if you're 30 for 20 years, you'll be 50. And if you invest into VTI, VUG, or QQQ, if you invest into QQQ or VUG, the actual interest rate will be a lot more than that. So we'll go through that. So investing to by investing to VU or by investing to VU and VTI, you can get around a 10 to 12% annual interest rate. And then by starting out, by investing that $500 per month, which is roughly $250 per check, at this point, you can be able to invest $250 per check when you're 30s, because you're essentially making more money. You are looking through your budget. You are trying to figure out the best way to make more money. And by doing that, you can figure out through your budget to squeeze out $250 per check to invest into. You choose VU, VTI, and watch the money grow. And then after the 20-year period, as you see, boom, you have amassed a portfolio of $432,000. And then by that point, if you or your significant other, if you feel like you can invest more money with both you guys' money combined, you can do it, or just yourself, because we know the older we get, the more we get promotions and we get bonuses and you get taxes. You can be able to increase even more. So imagine you are contributing $250 per check, and then you begin to make more money, and then you want to increase it to, let's say, $600. That extra $100 difference moved it from 400 some thousand to 500,000. So the more money you be able to make, the more money you can be able to contribute per month to get you to your goal to making having over a $500,000 portfolio. And then lastly, what I could talk about is that also what people tend to do to amass more wealth in the 30s is to invest into crypto. And two famous cryptos that people invest into that's extremely risky, but if you have the extra money to do it, people tend to dollar cost average and buy Bitcoin. $50, $100 into Bitcoin per month, and then also people tend to buy $50 or $100 of XRP here and there, just so you can have exposure to crypto. But overall, the best way to make money and to invest your money into your 30 so you can be wealthy is what people tend to do is that they do a combination of, you pick two ETFs, rather it's VU and VUG, a S&P 500, and then VUG, which is the growth, so that you invest into the S&P 500, where you know that your money is going to be stable because it's spread out amongst 500 companies, and then you invest into VUG to get that growth component. Or what people tend to do is that they may do VTI, which is the whole entire market. When the market goes up, you make money. When the market goes down, you lose money, but your money is still diversified amongst 3,600 stocks with VTI. And then also people tend to do is split and do half in VTI and half in QQQ, because we know that going forward, tech is going to be king. Tech is going to grow. Microsoft is going to grow, steady grow. Tesla is going to grow. Everything's going to continue to grow and get bigger. And so invest into a total stock market ETF, and then QQQ to get that Nasdaq tech exposure. And then if you have enough money, then you can invest into single stocks like Apple, Tesla, or Amazon. If you have enough money, you don't have to. And then you just pick a budget and you figure out if you could do only $250 every 2 weeks, do that, and then split it, and then just build upon that. And then if you could do more, when you get bonuses, when you get commissions, when you get extra money, when you get raises, you can increase the amount. And then by that, you see with this example, you see that by even contributing just a little bit, $600 monthly, which is essentially $300 per check, $250 per check, in a span of 20 years, your portfolio will grow, and then you can use that money to retire. And then also you invest into crypto as well. Just know that a lot of these avenues, whether it's stocks and crypto, is extremely risky, but with high risk, it comes high reward. And yeah, that's how you can invest your money into your 30s to retire wealthy. First, you start with a budget, figure out how much money you got bringing in. Then you figure out what index funds or ETFs you want to invest in. The S&P 500, VU, the total stock market, VTI, a growth fund like VUG, the Nasdaq, which comprises of all the tech stocks uh, of the United States, which is QQQ, individual stocks like Apple, Amazon, and honestly, only you can figure out your strategy and what you want to do between you and your family. I'm just laying out the different avenues of the way you can go, the different stocks and the number of tickers you can produce, and ultimately it's your choice of what you feel like. Because for me, for example, I like QQQ, I like Tesla, I like Apple. I have those in my portfolio, and I let it grow. But you may not like Apple, or you may not like Tesla. You may think that Apple or Tesla or Amazon is extremely too risky for individual stocks, and then you may just want to just buy QQQ. Or you may just like, you know what, hey, I'm new at this. I just want something simple. Just buy VU. If you want something simple, buy VU, buy VTI, put $250 every 2 weeks, and then boom. If you could do $100 every 2 weeks, $250 per week, cool. If you want to make more money and to be able to increase the how much money you're gonna be able to make in terms of market returns, then invest more. But if you want to keep it simple, VU, VTI. If you want to get a little if you want to get a little colorful, then add in a growth fund like VUG or QQQ. And then if you really want to get risky, then you do Apple.